All right. So if you've been following so far, you understand what I've been doing is piecing the puzzle together with bar, wave, Renko, and point figure. Right. The Renko with volume was the addition that came from David Weiss. Otherwise, the Wyckoff methodology really requires three charts, three types. There's a bar chart, wave chart, and point and figure. Um, but you can add Renko, and I know it seems like a lot of charts, but once you see the construction and put it into the process where each chart has a function and each function is followed by the next function, you have a process. So that I think is that just makes it more sense because you're not like distracted by multiple charts. It's A, B, C, D, 1, 2, 3, 4, meaning all part of a process. So just start at the daily and basically just looking for a daily trend. That's it. All right. You can look for support and resistance levels as well, but what I'm after is daily trend. That's that's what I'm looking for. By the way, on the ES, there's a big problem. Like I mentioned on the Russell chart, all the distribution and all that. But on the daily, if you could see this, this is one of my favorite indicators. Sometimes I use it, sometimes I don't. It's the Keltner channel. The Keltner channel, the way it works is, well, let me explain it first. The Keltner channel is really good for trend. And why is because I'll explain, like in trend, typically you have, and I'm not talking about from a technical analysis, but more from, math and statistics. What you have are, where is this? All right. Typically you have dots, which represent data points. All right, so there's a dot, 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 there's a dot. When you have a bunch of data points, right, in basic math or stats, to look for trend, all you do is a regression line like that. This is what, I mean, this is the definition of, or the initial, the most basic way to find trend is when you have data points and you draw a line through them, and that's your regression. All right, so this cannot be questioned. It's really not questionable because this is linear trend and this is the foundation of what is it? I think descriptive statistics. Anyway, so this is when you draw a line. But what about when you draw a moving average? Well, if you have the same set of dots, right? And what these dots represent, by the way, are swings. Swing high and swing lows. Those are the dots. So you have something like, if you would draw a zigzag, it would look like that. That would be taking the dots or data points and connecting them via swing high, swing low, because that's what they are. All right, so that's what the dots represent. Now, let's say you didn't use a regression line and you used a moving average instead. In that case, because moving averages have a lagging effect, they would not be in the center. They would be slightly below, like that. Why? Because they're lagging. Lagging effect means that they won't be in the middle of the dots. They will be below. Or some of the dots will be slightly below, but definitely within range. Like nothing special, just it might go down a little bit and then come back up, or down a little bit and then come back up, right? So that's how it should look in an uptrend. Basically, they would revert to that mean and maybe go a little bit below, right? The majority of the swing would be above and a little bit below, and that would be an uptrend. This is how trend is defined, folks, in outside of the crazy technical analysis bullshit that everyone is creating. This is trend. There's no this is in statistics, this is trend. These are two approaches. One is the linear regression and the other is a moving average that has a lagging, where and because of the lagging, the dots or the data points, also known as swing high, swing low, will be above, at, or slightly below the average and then go right back up. These are facts. All right. So the thing with the Keltner channel is that it uses this, but it also creates an envelope. So above and below. So you'll have like that and like that, like an envelope, top and a bottom channel. And it's dynamic and it's really good because when price is in the top channel, you have an uptrend. When price in the bottom channel, you have a downtrend. All right. When the majority of the dots should be, they should be in the up channel in an uptrend. So it's very simple, and the gap between the mean, the average, and the top of the envelope, as well as the mean and the bottom of the envelope, is typically around 4 to 5 ATR. That's what I mean. That's just the setting. Some folks will use 3. I would not recommend using 2, but typically 4 to 5 is pretty good. So you'll see that if you use that, and also within that midline, the average, you could use 1 ATR for, you know, to identify reversion at or around the mean. And you'll see that in uptrends, what happens is the swing high, swing low dots, they are in the up channel. You see, all that shit is in the up channel. Here it goes in the down channel, and this is threatening. If it tags that low, that bottom, for me, I would consider that a very likely trend change, and it would not be easy to get above. All right, so I mean, just using a technical approach. I'm not talking about, you know, lower high, lower low, and all that stuff, or like, okay, it goes down, reaccumulates, and then goes back up. When it hits that lower channel and it's channeling lower highs and lower lows in the middle to the bottom, that's a downtrend. All right. So you see the majority, it was just channeling in the uptrend. Ding, 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 ding. Channeling here, threatened. Why? Because it's penetrating it's going below and then reverting to the mean. Going below and then reverting to the mean. But they picked it up. All right. So reestablish the trend. What happens? Okay, right back to the average or within 1 ATR, and then just goes back to the average, setting up the pullback, all of these pullback opportunities. You know, rally, pullback, rally, pullback, rally, pullback, test, rally, pullback, pullback. But it's not. It's going to the top of the channel, like near the top, and then pulling back real nice. What I really don't like is this. When it hit the bottom of the channel, that is a big problem. Because the data point is on the downside now, right? So they better pick it up, because if it starts making lower lows and lower highs in that down channel, it's a downtrend. You know, and also this break was the biggest in 100 bars, and that is not good. Anyway, so this is very threatening. This is threatening that entire trend right there. Big problem. Big problem, because it means that the reversions now will be from the bottom to the mean, right? That's not good. So I just wanted to share this indicator. I'm not too crazy about indicators, but I do think that they are good for measuring. And this one is particularly good for helping you visualize the trend. Is it in the up channel or is it in the down channel? Is it in the up piece of the average to the top of the envelope, or are the data points between the black line and the red line in the bottom of the envelope? So this is very easy to, you know, identify trend. Very easy. Other approaches I'm not too crazy about, because I've seen a lot of the crossovers, right? They're just, you cannot use them without adding other things, because they just keep crossing back and forth. at least here you have a move to the top, hitting and reestablishing the uptrend. Then from the top, going to the mean, then going to near the top, then going to the mean, then going near the top. See, these are data points channeling near the top to the mean, mean to the top. Very easy to identify. And here, from the mean to the bottom. That's a potential big problem for longs, for bulls. Anyway, so the way it's being put together is use the daily trend, and then you have trend. Now what comes next? Level, right? Because if you're trading pullbacks, you need to know the levels. Anyway, so you have trend, then you have to go to level. Now this can be done many ways. You can use, there's many ways to identify levels. Some will use those what do you call order blocks or breakout level or whatever. I mean, whatever your approach is, right? Some will just take this low and draw a line like that, or go to a lower time frame and draw a line against the breakdown, or look for the order blocks or whatever, that type of theory. All it is a place to do a test. Okay, so over here for me, or they use different candles, they call all these different names. I don't really, for me, I'm looking at a smaller time frame or brick size Renko, because for the low risk entry. So you're going from the daily to a medium time frame, where you can see the swing of the daily as a trend on that medium time frame, which is smaller than the daily, right? So that will and I mean, over here you see very clearly, okay, there's a breakout, breakdown, whatever. So I mean, go here, and that's the level. So tap, tap, and go. Here it was right around here, as identified by the volume, right? Volume based support resistance. So it's like right here. I go tap it. Here the volume increases and reverses. Yeah. And also you get a heads up, like if it pulls back and then breaks down, then okay, that pullback. Here you had a breakdown. It did not have a lot of follow through. What does that mean? It means it's going to resistance or going to upthrust it. Same here. When you have breakdown and does not have a lot of follow through, what does that mean? The pullback is going to resistance or possibly going to be an upthrust. Right here you have breakdown and you have follow through. What does that mean? The test is likely to be at the breakdown level. Here you have a breakdown with follow through. If it has one more break, then I'll be expecting it to test the breakout or the breakdown. If it doesn't have a lot of breakdown follow through, what happens is the pullback usually tests the resistance and might upthrust it. So here I see it has some good follow through. If it has one more break, at least the first one should probably just test the breakdown. And that's it. I mean, it all depends on how much follow through you have after the breakout. If you have a breakout and has good follow through, then the pullback will be around the breakout. But if it's little follow through, then you have to be careful, because it means that it's probably going to go back up and do a stop run or hit resistance, as is the case here. At least that's the way I see it. I don't know, others have different theories and opinions, but I mean, I'm showing you right on the chart. Breakout, has follow through, test, then retest. Here you had a little bit of a breakout, very little follow through. What happened? Went to resistance. Here you had a breakout, only one brick follow through. What happens? Goes to upthrust, resistance, upthrust. Here you have breakout, you have some follow through, should have a pullback to the breakout, right? And unless it reverses, and we'll see what happens. Anyway, so the trend on the daily, the level on the Renko, with And you can use any approach to find a level. The idea here is to piece together trend plus level. Trend plus level. The trend tells you to go long or short. The level tells you where to look for trades, right? Where to go long or short. So trend gives you direction. Level gives you location. Direction plus location. What do you then do at the location? And that's where you go into a lower time frame. Here, for example, is a 5 minute, and the idea here is I'm looking for a turn. So you have direction, location, and a turn at that location, a U-turn. So now there are many there are different ways to look for I mean, there's not really different ways. It's just the down waves are bigger than the up waves. All right, when the up waves are bigger than the down waves, you have uptrend. When the down waves are bigger than the up waves, you have a downtrend. Now, how that turn occurs, when that turn occurs, what are the behaviors? Okay, then you have your climax, your change of behavior, sign of strength, sign of weakness, the low volume pullback, and then follow through, confirmation, etc. So that'll set up the move. That'll set up the turn at the location. Got the location, look for the turn. All right. So that I think is really critical. Now, a lot of individuals, what they do is what they're gonna do is on the wave volume. I don't know, wave volume or the wave. How are you measuring like demand and supply? You can obviously you have to have distance, and a lot of folks all they do is put volume here. They have some volume amount here and volume amount there. In my opinion, the volume comes later. I know that the entire, everything is based on wave volume and all that, but from what I understand from the Wyckoff material and even his recommendation was to use first, you use price and time. You use price and time. Then you add volume. Okay, that's not only that's actually recommended by Wyckoff when he created the wave. He said use price, time, and then add volume, and if you can, activity. But I think price, time, and then volume is enough. So I'm adding price and time and volume, and specifically in the order of time, price, and then volume below. Why? Because it becomes very easy to read. And also I think it's a preference thing. If you have volume here by itself, it will help. Some people just develop, but I think, well, first of all, time and volume are highly interchangeable, right? We know that there's a very strong correlation between time and volume. Very strong correlation, meaning high amount of time typically has high amount of volume. So the correlation is pretty big. And then price, you should have it because most of the change of behaviors are identified by a big wave. Most of it is identified by a big wave. Similarly, most climaxes, in my opinion, are identified more clearly by volume. All right, that's just what I've seen. Others will just say use volume, period. Others will say forget it, just use distance, but whatever. So I'm just giving you the recommendation from what I understand is use price, time, and then you can add volume below as an indicator. So I think like that's it's sufficient, and it's very easy to read, like time. Okay, this one was that shakeout, but from that you had trend. It's only 15 minute, 25 minute, only $118, 15 minute. It's not going to change. When you have a big move, it'll probably be 25 or 30 minutes with I don't know, 250 or 300 relative to this downtrend. You'll see that bounce. So it's more intuitive to read than volume by itself. Although some folks are very good with volume, and I'm just, you know, my preference is time and price, and then add volume below, and you will have a complete picture of the wave chart. Complete. All right. So in addition to that, when at a location price goes to test, you want to see a turn, but you also want to see the potential. So for that, use cause and effect. Like over here, you have at this, where is it? Here, at this location, on here, you see the 33. That increase in volume is bigger than 1, 2, 3 prior bricks. So that increase in volume is actually a redistribution. That increase in volume at that resistance level or location means there's some type of distribution up there that should be verified, right? So typically, as you know, that the volume will be like one bar has a lot of volume or multiple bars in a range that set up the distribution, right? So what's going on? You can see that that big 33 is because of this range of distribution, which was right here. Let me see. And use the box. That's your distribution. Okay, so on that pullback, the volume increased on the Renko, going to the location, like a breakdown or a high volume breakdown or whatever, and increasing in volume. Why? Because there's selling going on there, right? So what are you looking at for the location? You're looking on the wave chart, you're looking for a turn, and on the point and figure, you're looking for distribution. Because if there's distribution, it would mean that you will have what happens after distribution or redistribution? Continued markdown, right? I don't want this to be like just a tap. I need to see some cause, and here's the cause. So all you gotta do is box this shit right here, and you see the cause is what? 21. 21. All right, that's good. That's good amount of juice, right? It's not okay like little bit, 5 bricks or whatever, 5 boxes, and you just effect. So the effect will be about 21 as well, which is right here. 21 that projected the low, which is 4388.25. So what does this mean? It means that on the pullback, there was enough distribution here to break the low, to break that middle time frame low, right? That's what you want. At least that's what I want. I want there to be enough distribution to say, yes, we have enough juice to project a break of the low. I want to see a break of the low because so I can target the low, at least target the low. Yeah? And that's it. Right? So I went through the study, or the point figure study, I think yesterday or the day before, explaining what? Explaining the, oh shit. What was I explaining? Yeah, I was explaining like how the cause on the pullback set up the, right, the cause on the pullback set up, and what I mean by cause is the distribution or the count, how that was enough to take out the low. And you see here that it is enough to take out the low. And then it breaks and breaks the low. So that's really important. Now, if it continues to go down, what we want to do is take the lower count. But I think this is enough. Like, it's very clear. Even on the prior wave, right, prior test, you saw the cause here. 14 effect. What's the effect? 14. And sometimes it could be less, it could be 12 or 10 or maybe 15. I don't know. But the point is that there's enough cause here to break the low. And now as the Wyckoff trader or Wyckoffians, right, you have reason to measure, you have a way of measuring risk to reward. See, if I go here, I have enough reward. Not only will it give you potential target, but it'll allow you to weigh your risk to the reward, right? You have to be able to determine both risk and reward, not say, okay, my risk is 1% or some shit. Yeah. Yeah. So now I have a measurement saying what? I know that the reward is going to break the low. And this is conservative, right? It's right off resistance on the second line, right? Right off the resistance. I know it's going to projects to the break of the low. I have a potential target, and I have my risk and reward, and I don't do anything stupid. You know, that's the main main idea, which is what? Like, okay, it goes to the point and figure, and you just keep holding and holding and holding, and then it reverses, right? So here you have the count, you have the cause, you have the effect, you're trailing your stop losses and all of that, right? And you know it's going to break the low, or at least that is enough potential to break the low. So this is how you coordinate the daily, which is the trend. Then once you have trend, you need location, which is just I don't know, other folks say point of interest, right? POI, or level, or demand zone, or what was the other one? Supply zone, right? Demand zone, supply zone. You need a zone or a level, point of interest, whatever you want to call it. Once you have those two, then you need some type of signal or something telling you, let's get in. And that is for the Wyckoff traders, that would be a wave chart. It would be a lower time frame wave chart. Okay, you could do it with the bar chart if you can see it, the waves without the bars, right? You can do that, but this will give you clear measurements in terms of time and price about which side is stronger. Because if the down waves have more distance and duration than the up waves, the trend is down. If the up waves have more distance and duration than the down waves, the trend is up. So here we see that after this, the pullback is only 15 minutes, another pullback only 15 minutes, another 25 minutes, and the distance is not that good, right? You have, and I'm measuring distance, it can be measured, again, you know, you can measure it in ticks, right? But I prefer to measure it in dollar amount because I think it's more intuitive when it's dollars amount. It's the same thing because a tick has a dollar amount. So just why not use it in dollar amounts? Is it more intuitive to say this thing went down 30 ticks, or is it more intuitive to say it went down $300 and pulled back on only 100? I think dollar amount is more intuitive And especially on the reversal, like over here, if you see $74, $108, $118, $164, all of a sudden you have a $400 up wave. Relatively speaking, comparing it to the prior up waves, it would give you a sense of that there's definitely a turn. There's demand coming in, right? So for here, I'll give an example over here. From here, this leg to this leg, you see over here the down wave is from the start of the trend, $40, $40, $46, $65, you know, $50, $39, you know, 93, and it's still green, ding, 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 and then bang, right here. Look at the time and price increase. The time and price increase 70 minutes, whereas the prior waves were 20, 15, 10, 20, 15. So you're going from 15 and 20 minutes to 70 minutes. What does that mean? It means the down waves are now starting to attract a following, quote unquote. And when that duration starts attracting the following, it is identified by big change in time as well as a change in price, where you see it breaks the $100 mark and goes to $135. Whereas the rest was what? Oh, from the start, it's 46, 46, 49, 65, okay, 93, 54, 39, and then bang. You know that there's something going on here, right? And then it makes a lower low. Then it tests, goes down. Finally, you have that up thrust, which you're waiting for, right? That's the second wave up, second what's it called? Second test, the retest or whatever. And then what happens? Pull back, pull back, pull back. 3 pullbacks. How much do they go up? 15 minute, 15 minute. This is nothing. 15-minute waves. 15-minute. This one 25-minute, yet it only does $118 and has a lower high. And in fact, after that, it breaks. So this is effort. There's effort here. And it's quite dull. And this confirms it. So now, you know, it just tests and goes back down. Anyway, long story short, just keep following the course, read the course, and like just remember that what we're trying to do as White Coffeeans is you take the trend, then you get the location, then you get a turn, and when that turn happens, you'll know how much of risk. And now all you need to do is know that the next piece of the puzzle is the reward. So you know that there's enough reward to break the higher time frame or middle time frame low. And now you can compare or weigh the risk to reward and know that yes, there's distribution there. And what happens after distribution and redistribution? Markdown. Perfect. There's enough. The cause is there. You have to have a cause, right? You have to have distribution because markdown occurs after distribution. So you have to have distribution. The markdown is after it. It's a prereq for markdown to have distribution. So the prereq is there. And now you have the, all of that stuff. So now it should go to, and then the other part of it is the risk management piece. Like, to elaborate on that, you have to know how to move the stops. You have to know how to move the stops and when to move the stops. Right? The risk management is, if you know your risk, you know your reward, you know the distribution, you have your trend, you have your location, you have the turn, and you have your risk to reward. But your entry, how to enter, where to enter, what is it that you're looking for, that piece in your trading plan needs to be clear. And then once you enter and how you stop, how do you then move the stop on the way down or up to your price target? There, once these components are clear and written down, you have you know what to do, and you know what to do next. You know what to do, when to do, how to do, and what to do next. And that's what the trading plan is all about. It's why it is absolute. It's not just okay, entry, stop, target. That's not what a trading plan is. That is, I don't even know what that is. But anyway, good luck. Have fun. Thanks. Bye.